Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show, my charts guy, Mike Gable from Fairmont Equities, has a look at 5 stocks I'm interested in. One is Nuix, which really has been in the news lately, Megaport, Avita Medical, Treasury One Estates, and the one he likes, Aristocrat Leisure. Which ones are really a buy now, or maybe a buy later, or possibly a sell? Then Paul Rickard assesses Xero and EML Payments, which has been a star performer for my Zeet group of stocks, but recently it's copped some bad news from its OS operation, and the market really clobbered it a couple of days ago, and now it's rebounded a little bit, but it's still got a big question mark hanging over it. If the news around email payments is excessively and inaccurately negative, it could be a buying opportunity, or maybe not. We'll talk to Paul about that. And then we learn how you can borrow to buy shares with Lily Elliott, who's the head of leveraged at Bendigo Adelaide Bank. It is a risky activity, but you can do it with a bit of safety built in. Lily tells us how you can do that. And then Coolabah Capital's Ying Yi Ann Cheng will talk about where she thinks interest rates are going. Could we be in for a shock rise in interest rates? That's the show, so let's kick off with Mike Gable from Fairmont Equities. Well, there's a bit of volatility on the stock market nowadays, and tech stocks are the ones copying it the most as the markets seem to be rotating into value stocks or stocks that are going to do well with the reopening of the economies around the world. And I've got Mike Gable from Fairmont Equities to look at some stocks that are in the news, and Nuix is one that has particularly been in the news. Mike, thanks for coming on.
Thanks, Peter.
So what's your take on Nuix? I know it's early days. I probably would have rather waited 4 or 5 weeks, but by then it might have taken off. What are you seeing at the moment on the chart?
Look, the chart is still pretty negative, as we can imagine. It's been on a bit of a slide. I mean, we looked at it in March. It looked a bit negative. It's still looking a bit negative. Of course, it's a new listing, so we don't have a lot to go off. No. So what I've found is, as you can see on this chart here on the screen, I've pulled up the 20-day moving average. So sometimes it's interesting to have a look at different moving averages and how every stock has its own sort of personality and how it likes to trade along these moving averages. And if we try the 20-day moving average, we could see that it seems to respect it quite well. So by that I mean, if we look at the top left, initially when we had at least 20 days worth of trading, it tended to sit on top of it quite nicely. But ever since it fell in early February, it's been hugging the underneath of that 20-day moving average. Which is
a good sign.
Not for now.
When it's above, it's like the market's really in love with this stock.
Yeah, exactly. So something like a 20-day moving average is, I guess, a fairly short-term thing. We can move to obviously 50s, 100s, 200s. This hasn't been around. Yeah. This hasn't been around long enough for that. But at the moment, I think if you're an investor looking to pick this one up when it's back up and you don't have very good charting skills, I'd just pull up a 20-day moving average. It seems to respect it quite well.
And when you say respect it, to me it's underneath it, but you're saying it's close to its 20-day?
They're sort of dancing together. It's one's on top. They're sort of staying alongside each other. So.
And of course, right in the middle, there was quite a big departure, wasn't there, around March? Yep. But since then, you're saying it's
come back to it. It's respecting it.
Okay, good.
So I'd wait for it to get above that line, maybe give it a few days to see that it's holding on, and then that would be, I guess, an early indication. Yeah, an early indication that it's actually heading higher again.
Because it seems to me this is a company that has a future, but overhyped. CEO didn't impress at the Macquarie presentation. Bad report first up, never a good sign.
Yeah, exactly.
So there's a lot of rules of thumb that would go against this and the market would sell off. But it seems to me what it does has potential, and so I'm interested to get a good opportunity to buy.
Yeah, it's just a case of waiting for everyone else to give up on it, forget about it, and move on to something else, and then it'll probably bottom then.
Okay, let's go to MP1. And the history for me was, I didn't know much about it until I interviewed Bevan Slattery, who's the founder of it. And it just seemed to me this was another company that's in the space of where companies will want to be in the future. And it's, basically since March, things have been on the improve. It's come off the boil. I've kind of suspected, because most tech stocks have been given a bit of a clobbering lately.
Yeah.
But what are you seeing here, mate?
This is looking good. So just to recap for other viewers, we've looked at this a couple of times together. Has looked negative, and then when we spoke, I think it was a few weeks ago, I pointed out that by rallying strongly and going above the February peak, that was the first sign of the downtrend breaking. So the horizontal blue line there is at the February peak, and we could see that it's managed to get through it. I mentioned at the time when we spoke a few weeks ago that, look, it had run pretty hard, so therefore it's likely to come back, wait for it to settle down, and that will be your buy point. So it looks like the share market's listened to me on this one, Pete.
Oh, of course
because
it is. That's the only reason you're on the show, Michael.
Because as you could see, in early May, it did come back.
Yeah.
The last couple of weeks, it has settled down nicely above $13. Now, this chart, I produced this before today's trade, but coming in to speak with you, Peter, I noticed that it's up quite nicely in such a way that I'd say it's a buy signal today. So the way that it's turned around today is telling me that it's ready to get going again. Look, if it can't get through that sort of blue line again, or even let's just call it 1450, if it hits that and then really struggles, I'd be concerned. But from what I'm seeing today, Peter, it looks like a buying opportunity.
Okay, right, yeah. And by the way, remember, ladies and gentlemen, this is not advice. This is our best shot at trying to guess the future. And when it comes to stocks, guessing the future can be a bit tricky. Let's go to our next one. And this is a Vita Medical. And I should explain to people out there, this is a company that was initially formed by Dr. Fiona Woods, the Australian of the Year, the lady who created the plastic spray on skin that helped the Bali bombing victims and a lot of other burns victims. And it then became a listed company. It's also listed on the NASDAQ as well. And I've just noticed that in its American situation, there seems to be a lot more positivity than what we're seeing here. And I just wanted Michael to tell us what he's seeing on the local side of this.
Yeah, look, at the moment, unfortunately, with the Aussie shares, they're looking as though they want to head lower. So it'd be interesting to see which market is correct in their assessment of AVH. So we could see that clearly over the last few months, the shares have come back to that December low. But instead of coming close to that December low and bottoming out and having volume get pulled out of the stock, it's done the opposite. So if it had bottomed out there with low volume, that would mean it's close to perhaps rallying again. But what we have here in the last couple of days, it's fallen quite dramatically down towards 450. So this is after they had their quarterly.
So from 550 to 450.
In a very quick period of time. So, and this was on the back of that quarterly update. So the market got the update, the shares were up, all's okay. But 2 days later, it looks like someone's looked at the numbers and doesn't seem too happy with it. So, so it's gone all the way back to 450. What I've circled here is the dramatic fall in the share price, and then along the bottom, that
that little circle is an actual.
That's 1 day.
1 day.
That's one day, and then the bottom of this.
And the length of those little candles also give you an idea of the volume as well.
So the volume's at the bottom. So that the bars along the bottom is volume, but the length of the candles tells you the size of the trading range.
Okay.
So in a nice happy market, nothing to worry about. The trading ranges are usually pretty small. They just slowly head up.
It's a good small trading range.
But then when you suddenly get these big moves, it's increased volatility. It's a sign that not all is well. And in this case, what I'm showing with the bit circled at the bottom is the spike in volume. So we could see that volume was, apart from the odd spike, generally pretty low as the shares were coming down.
Well, on this particular day.
But instead of staying like that, they really spiked up, which tells us there are a lot of investors heading for the exit. Rightly or wrongly, that's what they're doing. And even today, again, we don't have today's price action on this chart, but it looks pretty lackluster today when the market's up quite nicely. So I think for the moment, we're going to see a bit of
keep your powder dry on the Vita Medical until we get some other information. Let's go to another one, and this is Treasury Wine Estates, and we know that the Beijing bully boys are picking on Treasury Wine Estates with tariffs and whatever. And of course, a bit like A2 Milk, it's a potential takeover target, because the value of the company's been made cheaper to buy. I'm just intrigued to see what the market's doing at this point in time. So what are we seeing, Mike?
Look, there's for this, there's, I guess, a long-term and a short-term perspective on the chart. So longer term, we can't see it here, but this stock was trading closer to $20 a few years ago. So it's copped a bit of a hiding over the last few years. But even with this daily chart, which goes back about 1 year, we can see that it's been very volatile. We're talking about lows near $8, highs near $13. For those who could see the candles on their screen, very large trading ranges. So, you know, if you sort of got in perfectly at the start of a move, you've done well. But if you've just missed out by getting, you know, being 1 or 2 days too late, you might have copped a bit of a hit as well. So
and I'm trying to work out, Michael, looking at this chart, looking at the long red candles, was it August or was it December that China decided to whack tariffs on TWE?
I think they've had a couple of cracks at it, haven't they?
A couple of cracks at it. Each one of those long candles suggests that, but go on.
Yeah. So when I see a chart like this, I then like to wait for those days to settle down, wait for volume to ease out of it, and then it's just a case of waiting for a bit more of a breakout in the right direction. So what I've indicated on the right-hand side with the blue lines is up until a few days ago, the range did start to tighten up. So even though the shares were drifting back again towards $10, the range was tightening, which was a positive. And then as we could see when they gave that update to the market about a week ago, they've popped up. And what I've circled at the bottom right, so again, I've put a volume chart.
Big volume in a positive.
So that's all good.
Yeah,
so that's sort of textbook.
So this might be promising for TWE.
If we're just looking at the last sort of few months, this all looks good. It looks like it's found a low. It wants to rally. Volumes coming in, all very well. But when we look at this longer term sort of picture, it's still very volatile. So I'd say this looks like a hold or a buy for those who are happy to wear a bit more risk, given all the problems that are happening.
So in a perfect world, in 3 or 4 weeks' time, you can test out that really nice spike to see whether it's actually being a sustainable spike or whether it's just a one-off.
Yeah, look, I mean, it could just continue on upwards from here, but again, there's just that risk that it's a one-off. Again, looking back at this chart over the last year, there's been a few one-offs, unfortunately.
Imagine if President Xi said, look, we're sick and tired of picking on TWE. What would happen to that share price?
Idle.
$15, $16, I'd say.
Yeah.
All right, let's go to the next one, mate. Now, this is your favourite. This is Michael's choice. I always say to him, give us the one that you like the most at the moment. Now, what I find interesting about Aristocrat Leisure is it's been doing really well, and you seem to think it's going to keep on doing well.
Yeah, I think so. So, look, I know my last few picks for you have been resources, so I thought I'd find something outside
we're getting a bit bored
that
with
space. Yeah. Look, I to be honest, I did mention this one back in February, so I know I'm rehashing an old idea, but look, as anyone could see, it's just going up. And
so you're proving to everyone how smart you are.
Yeah, I was trying to sneak that one in.
He's always doing business, this guy. Anyway, if he was crap, he wouldn't be here, but go on.
Look, to be honest, I'm not just saying we bought this ages ago and it's doing well. No. Look at me. We have been buying this one as recently as a few days ago. So still buying Aristocrat. I still think it's got further to run. Charting wise, when we looked in February, it was during that period where we could see on the chart, we've got the diagonal lines. So we're indicating that it was consolidating under the old high. So all the way at the left, we could see the February peak. So that price action was telling me it was ready to get going again, and we could see it's been trending nicely. We had an update from the company earlier this week, upgrade to guidance. So their results will be next Monday, but they upgraded guidance, basically surprised everyone at how well they're doing.
Yeah.
And what we had was a gap to an all-time high. Now, I know people out there are scared to buy things at an all-time high, but if you want to be invested in something that goes up, it's going to make highs. That's the nature of it.
Yeah, if you had that philosophy, you would have missed out on a lot of Apple price rises.
Yep. And I'm sure for any of our viewers watching, if they bought something in the last 6 months that's doing quite a bit of damage, chances are they bought something that was going that way instead of that way. So I know it sounds very simplistic, but just buy something that's heading that way. So, so Aristocrat, yes, it made an all-time high a few days ago, but the way it's held up the way it's held up since then, since that announcement, it's telling me it can continue to kick on. So it's not as though the market's come in and sold it all the way back down and said this is as good as it's going to get. It's held in there really well at these all-time highs. So I think it'll just continue to trend and make new highs as we go
So
along.
while I was listening to you, man, I just thought to myself, what we should get you to do is just do a summary of the stocks you've selected this year. There's probably about 5 or 6.
Yep.
And just make a promise to us that when you go off them, you let us know. So like my viewers know. How's that sound?
Well, I think off the top of my head, we've had Iluka. That's down a bit today, but that still is above from when we spoke about it. Western Areas, BHP. Yeah. I think we've had Fortescue, James Hardy.
I think
the common theme is they're going that way.
That's right.
Just make sure they're going in the right direction.
And mind you, given my very vocal viewers, if you were crap, they'd tell you. That's Michael Gable from Fairmont Equities. And that's Mike Gable from Fairmont Equities. And now we're going to be talking to Paul Rickard of the Switzer report. Paul wrote a story today on Xero. What do you think, Paul? What's going on there?
I thought it was Monday actually, Peter, but look, I'll take today. But look, I'm looking like a hero because I read a story saying I think Xero should be part of your core portfolio. That was where it closed at last Friday at $112. Had a good rally the last few days. But I still think there's a bit of value there, Peter. It's not a stock that you need to... it's going to really tear off, but it's just a good, solid, I think one of probably Australia's best
all right, so when you wrote the story, it was around 111, and you thought it was a buying opportunity. It's now 123. Okay, you're a genius.
But nice of you to say so.
But to my way of thinking, Xero reminds me like the Apples, the Microsofts and Amazons. They are the sort of the more blue chippy type tech stocks, where other ones can jump around like nobody's business. And we'll talk about EML in a moment as well.
Yeah, I mean the scenario for established tech companies have got a genuine growth, good business, strong cash flow, and a sticky product, which is what your Microsofts or your Apples, or for that matter, a Xero has.
Because a small business person who got Xero sticks with Xero.
In the same way, once you get onto an Apple phone, you don't change, right? It's too hard. You buy the next model, right? And you buy other things around the app, right? Same with the sort of accounting software. It's exactly sort of the same. So I think it's of Australia's tech companies, Peter. I think it's probably the best. That's the ones of the listed ones. So Lattice is in a different category, obviously. But so I think when the market really wants to sell it, that's the chance you buy. And
buy the dip on Xero.
And really, last week's sell-off when they reported their full-year profit results, 31st of March. It's actually a pretty good report. Some of the analysts didn't like it because their EBITDA was a bit less than they were talking about, and that's because they're reinvesting in the business. So I don't think that was the way to look at it. So I thought it was pretty positive.
Okay, so that's Xero. Let's go to EML payments. Now, EML has been in my Z groups. It's been one of my best performers, and a bit of shock news coming out from the Bank of Ireland, Central Bank of Ireland?
Yeah, I mean, the Central Bank of Ireland, about 30% of their payments revenue is now directed out of Ireland. The reason it's out of Ireland is that I think sometime late last year, because of Brexit, they sort of moved their European business out of the UK into Ireland because of the arrangements around the end of...
And of course Ireland will remain in the EU where
Ireland remaining in the EU, and of course now a few months later the Central Bank in Ireland has come back and said, look, we think there's some AML breaches and we're going to use...
AML breaches for normal people?
Well, anti-money laundering, right? In other words, that there's... EML is doing something through its payment systems. In other words, not enough to identify that there's money being used for the wrong purpose, or criminals are transferring money, or whatever it is, and has implied that they're going to take some sanctions under the Banking Act in Ireland.
If they're right.
If they're right. So, but I think what EML said yesterday, Peter, they sort of admit there's a problem. They just don't know the extent of it. And the problem for shareholders, Peter, is that there hasn't, apart from that statement from EML yesterday, there hasn't been a lot of clarity. And what tends to happen with these things is when you have regulatory breaches, and we're assuming this is what it turns out to be, Peter, it may be that they're able to recover from this. It means that the regulators in the other jurisdictions they operate suddenly start taking a much closer look. And you saw the damage that the AML stuff did to CBA, it did to Westpac. And I guess this is a third company. Now, the problem for a company like EML, which is a growth story, doesn't have a lot of earnings, and so a fine or sanctions could actually hurt it. Maybe the market overreacted yesterday, was off 46%, bounced a fraction today, but the problem is you don't actually know.
That's right.
whether there's the end of it. So the question for EML holders is, what's the catalyst to re-rate the stock? And I suspect we're now in for a period of several weeks, maybe longer, of uncertainty about the company.
Yeah, until we find either it's bad news or good news, and that's going to be critically important. But Paul, from my point of view, this emphasises why I always say to investors, you can't be overexposed to any one stock. That's why when I picked up the Zeet, I had put 4 of them in. 2 of them, EML and Zip, did fantastically well. ELO struggled. Tyro was hit by a hedge fund, a bad and false hedge fund report. It's now starting to come back. But about 2 or 3 weeks ago, I said, if you want to create your own tech fund, take Wax, add Zeet, and throw Megaport and XDC in. And that's a great collection of Australian tech companies. And I think over time, there's so many good businesses in there. When this bad news comes along, the others will offset the bad news. It'll be interesting to see how that little tech stock goes.
I think you're absolutely right, Peter. You can't. The only way to protect against single event risk, and that can include things like a regulatory breach or the CEO doing a dumb thing, or having an affair, or whatever it is.
Or a treasurer coming out with a bad policy.
Changing government policy is you have to diversify. Otherwise, you just can't guard against it. And that's why we talk about it. And EMLs are probably a good example of that, because a week ago everything was going honky dory. This stock was sailing, done an acquisition that the market had sort of given pretty high ticks to. Suddenly something's happened, come out of total left field, and the share price dived 46%. I'm not jumping in, Peter. I don't think it's going to be quick to recover until we know more about the extent of it and whether there's any follow-on action from the other regulators it deals with.
Yeah, I must try and get Tom Cregan, the CEO, on the program as soon as possible. Thanks, Paul, for joining us.
Thanks, Peter.
Well, a lot of people say to me that they've got some great ideas to invest in the market, but often they haven't put enough money onto that great idea. Well, this segment here will probably show you another way of doing it. It's a little bit more risky than just putting your own hard-earned money into the investment. But I'm joined by Lily Elliott, who's Head of Leverage at Bendigo Adelaide Bank. Great to see you.
Thank you for having me.
Now, a lot of people will be wondering, you're Head of Leverage. What's leverage?
So leveraged is a margin lender. We lend money against the purchase of shares, managed funds, ETFs and so on.
Okay, some people will be asking, I always ask questions, I think people are, what is margin lending?
So it's a loan that allows you up to 75% to lend against shares. Most of them are blue chip shares and equity that we evaluate to be stronger performers in the market.
So there's like a stable of stocks that you're happy for people to get a loan against?
That's correct.
Okay. You've been doing this for 30 years now, Bendigo Adelaide Bank. Was it an unusual thing to do back in those days for a bank that's always been perceived as a community bank?
So first and foremost, Leveraged was actually owned by Ord Minnett, who was a stockbroker.
Yeah.
Adelaide Bank purchased it in early 2000, kind of fitted in with that third-party model, and it diversified the bank away from where it was with just the mortgages and deposits. So that was the strategy then. The margin lending business has operated quite strongly over the last 2 decades under the bank and continues to provide that diversity in the bank.
Now we know there's a whole lot of young people out there who, being Australians, are addicted to a thing called property, but with term deposits so low, it's really hard for them to build that deposit up. Are a lot of investors now using this kind of investing with interest rates so low more than ever before?
Yeah, we're seeing an increase coming in, definitely. And we've seen that through our trading platform as well. So in terms of the next generation between 18 and 35s, we've seen an increase from last year, 30% increase in applying for margin loans. And whilst they only make 5% of our total customers, we are seeing that trend coming through.
Okay, now I've got a question here. And most people know I never ask the questions that people ask me. I just say I'm going to ask these questions to get you in. But this is an interesting one. In corporate tax planning with good debt, tax deductions, what are you trying to say there?
So it's really around, and again, we're not advisors. Most of our customers are advised, so we don't go there. But there is an opportunity there, and it may work for you. And negative gearing is one of those things, right?
Okay, so this in corporate tax planning is just basically negative gearing could be tax effective for you.
That's correct.
Not for everyone, but it could work. So probably would be good for those people that are wondering, what are we talking about? And there are normal people out here who watch the show and want to get rich at the same time. Why don't you explain how it works, this idea of a margin loan being tax effective and whatever? Okay, give me an example.
So it's very much like an investment property. So you are borrowing money for that investment. You may be in between that time earning an income. And the same goes with shares. So you've got the dividends, which is a franked dividend as well. So that's another effective way.
Like the rent?
That's correct. Another effective way of looking at the strategy for your trading. So.
Now, all of this used to be a bit scary for some people because I remember in the 80s they might have gone into this with interest rates at 7 or 8%. Yes, they were paying 7 or 8%, and all of a sudden it went to 17%. With this real historically low interest rates, are people starting to think maybe I might have a crack at this?
Yeah, we're seeing a lot more interest in margin lending now than what we have even a couple of years ago. So yeah, interest rates have quite a large reason for that, including the fact that the equity markets are performing so well and are anticipated to continue to do so for the next 12 months. So there is an opportunity there.
Is there also a lot more enthusiasm because the central bank inexplicably and historically significantly are actually telling us they're not going to raise interest rates for a long time?
Well, that is one of the factors, absolutely, and part of the evaluation that an investor makes before they decide that they want to take up gearing.
Okay, that's the great stuff. And what are the interest rates approximately for these loans now?
It all depends on the value of your loan, so they can range anywhere between 6% down to 2%.
Yeah, so all right, okay. Now, let's talk about the scary bit. When can a margin loan become a bit scary?
Well, one of the reasons, one of the times is obviously when the market is starting to fall, and we're seeing that plummet. The other is when an individual does gear themselves to the full extent. So that's something that we've seen less of now. And it has shown through, particularly through the times where the market does become volatile in a negative kind of way. So, and the other is obviously when you're not planning for a soft landing, anyone that is going to take up margin lending needs to think out carefully exactly how they'll manage that and what will their response be to a margin call. Now, a margin call shouldn't be a scary thing because you're just topping up your loan and you're making sure that you're remaining below the lendable value. But those are all of the things that investors need to consider before entering.
And I think a lot of people don't understand the idea that when a market falls and the BHP share price falls, why they would have to put more money in.
So this typically occurs when the value of your shares fall below the lending value. So that's when we will call on you to make an additional payment. You've got a choice there whether you decide that you want to add or top it up, or whether you want to share a portion of your share, sell a portion of your shares.
So you can always sell part of your shares as well.
That's correct. So there's a number of ways that you can meet that, including lodging more security if you do have that.
Yeah, and I think in many ways, a lot of people, if they give themselves a buffer, so the market can fall maybe 10 or 15% and there's nothing's going to happen, that's probably the safest way of doing it.
Yeah, absolutely, and that's what we're seeing. That's the kind of behaviour that we're seeing in our portfolio, and most of our clients are advised. The advice that they are receiving is to remain within a acceptable gearing limit, but also most importantly is diversification. So if you're going to be single stock exposed to a share that has a bad day in the market, then the chances are that you will be called.
Okay, and in the new world there are things called exchange traded funds.
That's correct.
Are a lot of people using these loans to get for example, ASX 200 exposure?
Absolutely, and more so in that area. But interestingly enough, we have seen growth in lending against ETFs. So compared to last year, we're up from 40%.
Okay. Is there anything else you think someone should know who's never done this before?
Margin lending? Good planning. If you don't understand it, get advice. And also, again, I think I mentioned that earlier, think through the scenarios and what would happen if you are margin called and how you would respond to that.
The interesting thing, Lily, is that the best time to do this was about March 24 when the market was right at the bottom, because then you've got fantastic leverage. Okay, so as the market gets closer and closer to the top, that's when it can become more risky.
Yeah, well, and again, it's about how you manage your ratios. And how well you're diversified. And again, even the growth that we've seen over the last 12 months, on an average, a client portfolio has increased by 40%, but we're still seeing gearing ratios at the same level, which shows us that customers are thinking forward. They're not thinking about completely gearing themselves, and it's a part of their trading strategy as opposed to all of it.
Great stuff. Thanks for joining us.
Thank you for having me.
That's Elliott from Bendigo Adelaide Bank. Well, inflation spiked in the US late last week, and people are worried about inflation causing higher interest rates. And our interest rate expert is Ying Yi Ann Cheng from Coolabah Capital, and Coolabah manages my Switzer higher yield fund. Ying Yi, thanks for joining us.
Thank you, Peter.
So were you guys surprised at the magnitude of that inflation spike in the US?
Yeah, well, I mean, firstly, we should clarify what inflation number it is, and that was US core CPI. However, we need to remember what matters to the US Federal Reserve is actually PCE. If we look at the components of that US core CPI number, it was quite significant. In fact, it was the largest single monthly increase that we've seen since 1981. So that definitely got the market quite riled up. It was very unusual. However, the point to note here is that you had very clear pandemic effects. If you look at the contributors to that bump up in inflation, it was actually used cars. So used car prices went up 10%. And that's the highest it's been in measured history. Why? Because people didn't want to take public transport. Therefore, they went out to buy used cars. And so that actually contributed to the 0.35% of the 0.9% increase. And then if you look at other things, it was related to chip availability for new cars. So obviously there's a global chip shortage, which we're well aware of. In addition to that, you're also seeing reversals of items that collapsed during the pandemic. And, it's a reflection of the economy reopening. So namely airfares and hotels. And so the Fed's message has been really to look through this sort of inflation. Obviously, we're going to see base effects or things rebasing. But yeah, at the end of the day, the number that really matters is the PCE, which will be out at the end of May.
All right. And for normal people, Ying Yi, what is PCE?
It stands for the personal consumption expenditures, and it's the primary inflation index that the US Federal Reserve uses when they're making their monetary policy decisions.
Okay, and so we know that the central bank was expecting a spike in the number, and it was bigger than expected. So are you guys saying or hang on, probably the better question is, how did the bond market respond to this? Because in recent times, we've seen the bond market sort of heralding maybe higher interest rates, and the stock market hasn't liked it. What did the bond market do when they saw this number?
Yeah, we did see yields move up. So fixed rate bond prices actually sold off in response to that. If anything, over the last couple of months, markets had sort of stabilized. So that fixed rate bond market had really sort of stabilized, because obviously we saw February, which was a bit of a bloodbath. And so really, yeah, this is a bit of a shake-up. Is it alarming to us? Not quite yet. Because we still need to sort of see these sort of effects. Obviously, equities did sell off, but in terms of credit markets themselves, there wasn't too much of a reaction. And by the way, in terms of the Switzer high yield fund and all of the Coolabah strategies, we run at typically zero interest rate duration, which means they're 100% floating rate. They're not fixed rate. So as bond yields move higher, we actually benefit in our portfolios.
Yeah, so and that was going to be my next question. Thanks for stealing my question, Ying Yi. All right,
No.
all right. So looking at this then, clearly we're going to hope to see in the May figure, the June figure and July figure, that these sort of one-off effects which come out of the coronavirus and the pandemic effects and the closures and the reopening of the economy, we want to see a downward trend in this number.
Well, I mean, we can't take away from the fact that, headline inflation is going to be higher. It's going to be the same case in Australia because you do have a lot of those pandemic sort of effects or as the economy reopens. But actually, the intention of the central banks is to create inflation, or at least in Australia, the intention is to create some sort of inflation. And so the focus for the RBA, at least, is really very much around employment and getting wage inflation to create, core inflation as well.
Okay, so budget night, when you saw what the budget looked like, when you saw the kinds of spending there, what was the view from Coolabah around what this might mean for interest rates, for yields, and ultimately the fund that you guys manage?
There's not many sort of huge implications for rates per se. It's definitely not the same sort of shock and awe for bond markets as when people were looking at the US and Biden administration passing their $1 trillion stimulus package. If anything, look, the starting point for the budget, the Commonwealth budget, I should say, was much better. But we are going to see a big windfall for subsequent years. And it's very clear that the Morrison government is positioning for the election, which could be as soon as August next year. So in terms of what we saw in the budget, we saw, low income tax cuts for next year, small business tax rates for the couple of years, and also really, putting out fires in certain areas or issues around aged care and women in terms of their spending.
I guess the bottom line question I need to ask you, you guys have had a view that you've actually agreed with the central bank that interest rates, shouldn't go up until 2023, 2024. Has there been anything you've seen since the last time we've spoken that has changed the House view on that?
No, not really. And if anything, we saw the RBA Assistant Governor Gable come out recently to reinforce that view. Again, people have been, for example, concerned about, the impact on house prices. We're obviously seeing, house prices increase, and therefore, should we really be keeping rates so low, et cetera. But the view from the RBA, or at least the RBA's message, has been, sure, we are getting an increase in house prices. However, at the same time, should we be doing this at the expense, should we, be disallowing that at the expense of, creating inequality caused by unemployment? And so, they are happy to sort of look through that for now. And really, house prices don't really come into the RBA's remit anyway. There's always macroprudential measures that could come from the APRA. And so if we look at the RBA's objective, what they're focused on is more so unemployment, as mentioned. So getting that unemployment rate down therefore, reducing inequality that way.
Yeah, and in many ways, what Gable was saying was that house prices make people feel wealthier as well. They go out and spend, that creates jobs, and that actually works to beat inequality better than just keeping house prices low so people can buy homes. It was a pretty interesting argument. Ying Yi, great, thanks for joining us, and we'll catch up in a couple of weeks' time.
Thank you, Peter.